Let's take a look at the Dow Jones 30. This is a pretty interesting chart. Let me jump here to the Dow Jones 30. And again, it looks just like the S&P 500, doesn't it? You probably barely even know that I changed charts there. If we zoom out again, we see again that flag type formation, and it's pinching a little bit, as you can see, which gives us that ascending wedge. It's not a true ascending wedge, but it is pinching. Again, what do we look for in these formations? We look for declining volume. There's our declining volume, meaning as prices are rising in a healthy trend, we want to see volume pick up. We want to see buyers getting more aggressive. That's not happening here. That's not the case. If we look at a 7-day chart, this will give us some more perspective. Here's our flagpole again, and of course there's our flag, and there's our declining volume, and what we'd expect to see again is a move down. If I were to pull out my pointer and do some rough math, I guess, let's see, if we called this flag, let's say 12,300, where this flagpole started, and we come down here to somewhere around 10,800, so 12,300 minus 10,800 gives us 1,500 points. We would take that flagpole, and then let me jump to a daily chart. We would take our breakout over here, and our breakdown would occur somewhere over here around 11,600. Oh, sorry about that, 11,600. So we'd take 1,500 points from 11,600, which would put us at 10,100. Now I'd have to zoom out pretty far to show you what 10,100 would look like. Let's go with a 5-day chart. Let me see if I can zoom out that far. So 10,100 would be down here in this vicinity. Now this is interesting because I'm going to show you something else. We have a formation also known as a head and shoulders formation. In this case, this is a complex head and shoulders formation. They're big patterns. They're fairly reliable. And if I was even, very generous and drew the neckline of this formation somewhere around the 12,000 mark, somewhere in here, okay, that would be our neckline, 12,000 mark. Our top of our head would be up here around 14,000. That's 2,000 points. 14 down to 12. We take our break at 12. We deduct the 2,000 points, and where does that put us? Again, it puts us down at that 10,000 level, the same level as this bear flag is showing us. So all in all, this just does not look good for this market. I can't imagine that there's not more downside on this market. So that's the Dow Jones 30. Let's take a look at something else here, and this will be the Qs, the QQQQ, which is the ETF for the NASDAQ 100. If you don't want to buy all 100 stocks, you can buy the QQQ, the ETF. And let's pull up a daily chart of this. With the Qs, they're in a little bit of a different situation than the Dow Jones and the S&P 500, because the Qs, if they were able to break above the May-June highs here, they would actually enter a primary bull market, which raises some conundrums with Dow theory, because you basically have to have the Dow, the S&P, and the Qs all doing the same thing to really classify a market. We couldn't say the market's in a primary bull trend just because the Qs went into a primary bull trend. So we'd still have to stick with a primary bear trend, even though the Qs went into a bull trend. But still, I don't think this is likely to happen either. And we have a lot different look here. We don't have that same flag formation. And you may remember I had been talking all through July and August when we were back in this consolidation formation, and I was buying calls, and I said that I thought that even back here when we were at like $44, $45, I said I thought the Qs would hit 48. The Qs hit 48.50. As far as I'm concerned, they pretty much have fulfilled their target. I'm not sure I see a whole lot more upside on these guys. But let's take a look at a couple things. Let's take a look at my. This is my personal indicator, my 3C indicator, which a lot of you guys have been emailing me about. And I've been working with the guys at Blocks and the guys at Warden, and they've come up with a template for a whole bunch of the indicators that I've written. The 3C, the trend channel, my crossover system, and the MACD heat map. So we're putting all those in a template. So if you guys are interested in those, go to my site, click on the Warden link, click on the Blocks link, go ahead and sign up for it, shoot me an email, and I'll get you hooked up with that template. Okay, so let's take a look at the 3C, and this is an indicator that I use to measure accumulation and distribution. We're going to look at a 60-minute chart, and basically what we want to see is price making higher highs. We want to see the indicator making higher highs, and in this case what we see over here, we see price making higher highs, price making higher highs, price making higher highs. 3C, higher highs, higher highs. We get over here to the ultimate high, and we see 3C making a lower high. That's a negative divergence. This signals, this indicator is telling me that this is distribution. Instead of buyers, I mean, that's ultimately what's happening. We're seeing, price moving up because buyers are buying. But the big boys, the people who are moving big shares, big blocks, are distributing their shares to the retail crowd. So that's distribution, which means there's not support for the stock, and ultimately the stock, or the ETF in this case, falls. So that's distribution, negative divergence. That's 3C on an hourly chart. If we look at 3C on a 30-minute chart, we have very much the same kind of thing here. You can see it over here. Negative divergence over here. Even this attempt over here on Friday, very negative divergence. It's way down here. It should be very way higher than it is. Here's a 15-minute version of the chart, and we're going to zoom in a little bit closer over here, and you see what's happening. The marker again, higher highs in price, higher highs in price. We have a lower high in the indicator signaling distribution. That's 15-minute, and let's look at a 10-minute. Same thing, real bad here on a 10-minute chart, even on a 5-minute chart. Again, real bad on a 5-minute chart. So all in all, the Qs to me look like there's probably not a whole lot more upside. If we look at the QID, which is the inverse, which means if you want to go short the Qs, you would buy the QID. If you're not into shorting and you want to just buy a long stock, but you want to be short the NASDAQ 100, and we pull up 3C, we can look at it. And in this case, what we see is positive divergences, because look what's happening here. Prices making lower low, lower low. Indicators making higher lows, higher lows. This is positive divergence, which means we're seeing accumulation. We're seeing net buying by the big boys. So that's a very powerful, very powerful divergence. There's 15-minute. We're seeing the same thing over here at 8:14, 8:15. And notice the negative divergence over here on 8:21, and price rolls over right there. So you can see it works very well. Again, 8:10, we see a negative divergence and price rolls over. And over here on a 5-minute chart, we're seeing a positive divergence brewing, and it looks like the QID is getting ready to move up, which means the NASDAQ 100 probably is getting ready to move down. One other thing I want to show you, my MACD heat map, and I'm going to show you this on a 10-minute scale. And what we're looking at, we're going to look at the QQQs again, and just the very recent trend here on Friday. And when I basically the way I would use this is when I see blue and green, this is, for me, this is buying time. When I see yellow, this is hold. When I see red, it's time to get out. And over here, red, time to get out. So that's the MACD heat map for you guys that are interested. On a 9-day chart, there's a big triangle over here on the Qs. Let me draw it in for you. Remember what we talked about, triangles are consolidation patterns. And in this case, this is a really big triangle. These can operate as tops and bottoms.